Well, hi everyone. Welcome to the Hard Answers. I'm Tom Graham. Is Bitcoin money? For reasons I'll discuss later, the final answer is no. Bitcoin is not money. Is Bitcoin valuable? Yes, Bitcoin is currently valuable. But many things are valuable in bubbles. Beanie Babies, Pokemon cards, tulips, all of these things are valuable, but for a very short period of time. I know, now you're thinking, this guy just doesn't get it. But I do get it. I've been a computer programmer for the last 35 years on everything from mainframes to PCs. I've programmed in 15 different languages on 7 different platforms. I have an intimate understanding of technology, and in the case of Bitcoin, the blockchain technology. And I've also studied banking in the Federal Reserve banking system for over 22 years. I understand the Federal Reserve, banks, the FOMC, and why money is money. In order to answer whether or not Bitcoin is money, we need to know what money is. The history of money. In a barter economy, people traded goods and services for other goods and services. Lines of credit were established so economies and businesses could expand quickly. Someone got the bright idea that trading IOUs was way easier than trading chickens. So if I raised a few hundred chickens at home, I could simply write an IOU for 1, 10, 20 chickens and trade the paper for goods. When people wanted their chickens, they came to my house and got them. The miracle of paper money and currency was born. The value of the chickens was traded for the value of another good or service by passing a commodity contract from one person to another. The contract itself, the IOU, has absolutely no value except that it can be legally enforced to compel the debtor to transfer the chickens to the creditor. The chickens are the wealth being traded for the good or service. The money is simply a contract to transfer wealth. The contract is a store of value, equal to the value of the chickens being transferred. This is what happens when you write a check. You are entering into a contract with the person that you're writing the check to. In exchange for goods and services, you agree that an amount of wealth will be transferred from your bank account to the seller. But wait, you say, cash is not a check. You are not transferring wealth from your bank account with cash, so the cash must be what has value. Nice try, but no. Let me explain. Gold was shiny and didn't rust, and it could be pounded into extremely thin gold leaf and used to make entire rooms shiny. Kings loved the shiny and wanted more and more gold things. Gold's intrinsic value today is still its malleability, its shininess, its inertness, and its rarity, and recently also its ability to conduct electricity in electronics. But other things are valuable too. If a person that can make an awesome spear but a terrible basket meets another person who can make an awesome basket but a terrible spear, and the two of them trade one great spear for one great basket, who walks away with more wealth than they had before they traded? They both do. That is the magic of capitalism and voluntary trade. You get to trade something you have for something that you value more, be it a spear, a basket, chickens, or gold. Goldsmiths in England created modern-day banking when they started loaning out the deposited gold to borrowers with permission from the depositors for a promise of interest and reduced risk if the borrower didn't pay it back. These are the people who made the first IOUs backed by gold, and therefore made money. The rise and fall of the gold standard. The Continental Congress issued paper currency during the Revolution, known as Continental Currency, to fund the war effort, but they didn't hold any assets to back the money. When their creditors figured out that the currency wasn't backed, and therefore not real money, both state and continental currency depreciated rapidly, becoming practically worthless by the end of the war. The reason for them becoming worthless was that they were not backed by anything. The Congress didn't even have the power to lay taxes, so the notes were completely worthless and the economy responded with hyperinflation. The painful experience of the runaway inflation and collapse of the Continental Dollar prompted the delegates to the new Constitutional Convention to include the gold and silver clause into the United States Constitution, so that the individual states could not issue bills of credit or make anything but gold and silver coin a tender in payment of debts. This restriction of bills of credit was extended to the federal government as well, as the power to emit bills from the Articles of Confederation was abolished, leaving Congress with the power to borrow money on credit. Between 1776 and 1861, banks sprung up across the U.S. printing their own money. The banks that observed strict reserve requirements and had gold backing their currency proved to be stable. The others failed. In 1861, U.S. Treasury Secretary Salmon Chase printed the first U.S. paper currency. In order to finance the Civil War, Congress authorized the U.S. Department of the Treasury to issue non-interest-bearing demand notes. These notes earned the nickname greenbacks because of their color. All U.S. currency issued since 1861 remains valid and redeemable at full face value. Throughout the 1800s, most countries of the world standardized their currency on gold. In 1914, World War I broke out, and European countries suspended the gold standard so they could print enough money to pay for their military involvement. Unfortunately, printing money without having the assets held to back them created hyperinflation over and over again. After the war, countries realized the value of tying their currency to a guaranteed value in gold. For that reason, most countries returned to a modified gold standard. Once the Great Depression hit with full force, countries once again chose to abandon the gold standard and started the downward spiral of hyperinflation. When the stock market crashed in 1921, investors began trading in currencies and commodities. As the price of gold rose, people exchanged their dollars for gold. It worsened when banks began failing. People started hoarding gold because they didn't trust financial institutions. The Federal Reserve kept raising interest rates, trying to make dollars more valuable and dissuade people from further depleting the gold reserves. These higher rates worsened the Depression by making the cost of doing business more expensive. Many companies went bankrupt, creating record levels of unemployment. On March 3, 1933, the newly elected President, Roosevelt, closed the banks in response to a run on the gold reserves at the Federal Reserve Bank of New York. By the time banks reopened on March 13, the U.S. government had turned in all their gold to the Federal Reserve, and citizens could no longer redeem dollars for gold. No one could export gold either. On April 5th, Roosevelt ordered Americans to turn in their gold in exchange for dollars. He did this to prohibit hoarding of gold and to further the redemption of gold by other countries. This created the gold reserves at Fort Knox and made sure the U.S. held the world's largest supply of gold. On January 30th, 1934, the Gold Reserve Act prohibited private ownership of gold, except under license. It allowed the government to pay its debt in dollars, not gold. The president was authorized to devalue the gold dollar by 40%. He increased the price of gold, which has been $20.67 per ounce for 100 years, to $35 per ounce. The government's gold reserves increased in value from $4 billion to $7 billion. This effectively devalued the dollar by 60%. The outbreak of World War II ended the Depression and allowed countries to go back to a modified gold standard. The 1944 Bretton Woods Agreement set the exchange value of all currencies in terms of gold. It obligated member countries to convert foreign official holdings of their currencies into gold at these par values. Gold was set at $35 per ounce. In 1960, the U.S. held $19.4 billion in gold reserves, including $1.6 billion in the International Monetary Fund, enough to cover the $18.7 billion in foreign dollars outstanding. However, as the U.S. economy prospered, Americans bought more imported goods, paying in dollars. This large balance of payment deficit worried foreign governments that the United States would no longer back up the dollar in gold. Also, the Soviet Union had become a large oil producer. It was accumulating U.S. dollars in its foreign reserves since oil is priced in dollars. It was afraid that the United States would seize its bank accounts as a tactic in the Cold War. Therefore, the USSR deposited its dollar reserves in European banks. These became known as Eurodollars. By 1970, the United States only held $14.5 billion in gold against foreign dollar holdings of $45.7 billion. At the same time, President Nixon's economic policies had created stagflation. This double-digit inflation reduced the eurodollar's value. More and more banks started redeeming their holdings for gold. The United States could no longer meet its obligations. The gold standard ended in August 15th of 1971. That's when Nixon changed the dollar-gold relationship to $38 per ounce. He no longer allowed the Fed to redeem dollars with gold, which made the gold standard virtually meaningless, since it was on paper only. The U.S. government repriced gold to $42 per ounce in 1973 and then decoupled the value of the dollar from gold altogether in 1976. The price of gold quickly shot up to $120 per ounce in the free market. The U.S. gold reserves were now worth $49.7 billion, more than enough to pay all foreign dollar holdings. The gold standard was proven to be flawed only in the fact that it is ridiculous to try to control the value of gold against your currency through legislative standards. The bottom line is, you cannot set the price of gold to a specific number of dollars without setting the price of everything else to a specific number of dollars. When you try, it distorts markets and creates conundrums like eurodollars. However, having a currency backed by something tangible like gold or debt or foreign currencies was proven to be a must for all money. Currency itself has no value. Only the commodity it represents has value. Money is a contract that transfers the ownership of wealth. That wealth is held by banks in the form of real assets, debt, or foreign currency. Currency is just the paper form of money, denominated so it can be traded easily. Money is a contract that transfers wealth from one person to another. Wealth is an asset. The modern mechanics of money. The United States government has the power to tax the U.S. citizenry, so regardless of how much it borrows, it always has the means to pay it back. The U.S. can never go bankrupt. This is why U.S. bonds are so valuable. The Constitution forbids the government from creating paper money. This is why we need the Federal Reserve Bank. The government is required to sell bonds to raise money. The Federal Reserve Bank Federal Open Market Committee determines how many bonds are to be kept in reserve and how much money is to be created or destroyed and how many bonds are to be sold to the public. Regardless of how the FRB sets monetary policy, the government is paid for the bonds. When the FRB buys bonds from the U.S. government, or mortgage-backed bonds, or foreign currency, or gold, or other valuable paper, it literally creates money from thin air. That's because, remember, money is simply a legally enforceable contract to transfer wealth from one person or entity to another. The Federal Reserve takes in assets, the bonds, the gold, and issues an IOU for the money, for those assets. The IOU is the money, redeemable for those assets. The Federal Reserve is the only bank that can create money this way. Other banks are limited to creating banks via loans and the fractional reserve multiplier. Someone deposits money into a bank. The bank then has an asset, money, and a liability to the depositor. The bank loans the money to a borrower. The bank no longer has the money, but it does have a receivable, which is an asset. The borrower then buys something on the free market from a seller, and then the seller then deposits the money back into the banking system. The bank now has yet another asset to loan, but also another liability to the new depositor. Each transaction increases the money supply. As you can see, if this were to continue, the money supply would grow infinitely and we would be facing hyperinflation. This is one of the reasons we have a reserve requirement. The Federal Reserve Bank requires banks to send a percentage of all their liabilities, the deposits, into their personal Federal Reserve Bank reserve account. This limits the multiplication of the deposits. And that, in a nutshell, is how money works. Is Bitcoin money? No, Bitcoin is not money. Money is a legally enforceable contract. Bitcoin isn't. The assets backing the money give the money value. Bitcoin has no asset backing it and no institution that issues it to hold those assets. Bitcoin is a commodity that is traded in a barter system, exactly like you would trade gold bars for goods and services. It's traded on exchanges, has no intrinsic value, but due to its rarity and usability, it is valuable. And much like gold, people are willing to take it in exchange for products and services. It's worth noting that gold is no more money than Bitcoin. Trading Bitcoin is far more similar to trading gold for products than using money. Why is that important? I can take a Federal Reserve note to any bank in the U.S. and demand they give me U.S. coinage. Quarters, dimes, nickels, silver dollars. I can demand metal. I cannot take Bitcoins to a bank and make such a demand. I cannot take Beanie Babies, Pokemon cards, airline credit card reward points to the bank and make such a demand. I can't even take gold to a bank and make such a demand. In fact, I cannot demand any store or government take Bitcoin as legal tender for any debt, private or public, but I can with dollars. This is because a Federal Reserve note is a legally binding contract and Bitcoins are not. They can't be, because they aren't backed by anything but happy thoughts. It's important to note that gold, corn, and wheat also aren't backed by anything, and that does not mean they are not valuable. But they too are not money. Money represents a legal debt to be paid, which is also known as a store of value. Each piece of money is an IOU for a specific amount. Each coin or note is redeemable for an asset from the issuer of the money. The issuer guarantees that debt with an asset withheld from the economy, be it a precious metal, government or private debt instrument, or foreign currency. The money supply expands and contracts every time a loan is made or paid off. Without reserve requirements, an infinite number of loans could be made and the money supply would be infinite, which would actually negate the whole "there are only 21 million bitcoins" argument if Bitcoin was ever loaned out as money. Fractional expansion of Bitcoin without reserve requirements would make Bitcoin worthless in a heartbeat. Go ahead and think about it. If you made an electronic version of a Beanie Baby, it would be Bitcoin. Bitcoin is a fun distraction, and lots of people will make lots of very real profits that the IRS is trying to crack down on, quite unsuccessfully due to the anonymity of Bitcoin. But at the same time, if you simply trade Bitcoin on an exchange, it is a zero-sum game. For every dollar one person gains, another person necessarily loses a dollar. But people need to be aware that it is a temporary, unstable commodity in a bubble. It's not money. If an exchange gets hacked and your bitcoins get stolen, you have no insurance, no protection, no recourse. So keep them in your personal wallet just to be safe. Don't bet on Bitcoin being around for your retirement. It most certainly will not be around in 20 years, and probably won't be around by 2020. Pointing at a Merriam-Webster definition of money and using that as a basis to explain a financial instrument is silly at best. The financial industry is far more complex than that. The bottom line is that trade requires an asset on both sides of the trade of equal value. Money made trading easier by creating paper IOUs to represent the asset being traded. The IOU has no value without the asset behind it and the legal obligation of the issuer to redeem it. It's fun to pretend that Bitcoin is real money. I have no problem with people getting excited about it, and it's pointing a spotlight on how things might actually be in 50 years, once we figured out how to attach an asset to each coin. But for now, they're simply electronic Beanie Babies. One really good thing that has come out of Bitcoins is the blockchain technology. This might be used in a few years to replace the entire internet's DNS servers. This would offer lots of benefits to keep the internet open and accessible to all, but also may pose some unknown challenges. We shall see. Please click the subscribe button to see more videos like this. If you disagree with me, please leave a comment. My ears are always open, and I learn new things every day when people disagree with me. I'm Tom Graham. I'll see you next time on The Hard Answers.